The broadcast is now starting. All attendees are in listen-only mode.
Good evening. This is Jackie Knight with Security Trust Company. I am having a few technical difficulties. I hope that you can now hear me and see my PowerPoint presentation. If you would, if some of you would please open the question box by clicking the arrow next to questions, and please type me a little hello to let me know that you can hear my voice and see my screen. I would appreciate that. So I want to give folks a moment to do that. We do not use the, oh, excellent. I'm starting to hear from folks. Okay, good. So my audio is now going through. I think I was dead air a little bit ago. Thank you so much, folks, for responding. As I go through the presentation tonight, as questions come to your mind, we do not interrupt the webinar in order to take those questions and answer them, but we save that for the end. So if you would please, as a question comes to your mind, just go ahead and open up that same question box and type your question to me. When we get to the Q&A, then I'll open that and answer all of those questions. Thank you so much. We do record our webinars. So I am going to Good evening. Welcome to STC's educational webinar on self-directed retirement accounts and real estate investing. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm very glad to have you join me this evening. We're going to get started by telling you a little bit about STC up front. First, STC is a retirement plan administrator, so we do not provide legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't represent or endorse any particular investment opportunities. And I will be talking about real estate, particularly in this webinar. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to focus on real estate investing in a self-directed retirement account, but I am going to begin with a bit of information about retirement accounts, about the benefits and guidelines related to retirement account investing, STC in particular and the services that we offer, and then choosing and funding an investment with STC, particularly purchasing real estate, and then we will have time for your questions. Now, I want to begin with a definition of what is a self-directed retirement account. Some folks are unfamiliar with that terminology. What it means is that you hold your retirement account with a company that permits you to choose any allowable type of asset. So anything that is permitted by law, the IRS, ERISA, Department of Labor laws, whichever entity governs your type of retirement account, anything that they permit is allowable. So that would include non-traditional assets like real estate. We often have realtors and real estate investors interested in opening self-directed accounts, particularly to invest in real estate. Self-direction also means that you manage your retirement account investments. So you have control over those investments. You have to make the decisions that relate to those investments. And this self-directed industry is and has grown very significantly, and a large percentage of self-directed investments are in real estate. I'm going to quickly walk through several different types of retirement plans. Traditional IRA and Roth IRA, you may be familiar with these. They permit you to contribute up to $6,500 of your earned income each year into the account. $5,500 if you are 50 years or older. And the difference between a traditional and a Roth IRA is that Roth contributions are made post-tax. In other words, you pay taxes on the money that you put into your Roth account. However, when you begin taking distributions from a Roth account, qualified distributions after reaching retirement age of at least 59 and a half, those distributions are tax-free. They're not taxed. So that means that all of the growth, all the earnings that your Roth investments have made can be taken from the account tax-free as qualified. So that's a very nice feature in investments, having that tax-free earning opportunity. A SEP is a simplified employee pension plan. Sometimes these are used by small business owners or sole proprietors. They permit larger annual contributions based on the earnings of the business. Simple is a savings incentive match plan. Again, some small businesses, I see some partnerships use this type of a plan. Again, permits larger contributions than a traditional Roth IRA. And now I've brought out onto your screen 4 different plan names that all say former employer. A 401k is normally a corporate plan. 403b, often charitable organizations or nonprofits will have 403b plans. TSAs are tax sheltered annuities, and TSPs are thrift savings plans. If you formerly worked for an employer and participated in one of these types of plans, you can roll the money out of those plans into a self-directed traditional IRA or a SEP if you qualify for that, if you have a business. So just some things to think about if you have retirement account monies in old accounts. They can be rolled into a new account, and they can be consolidated as well. I want to talk with you briefly about the benefits of self-direction. And the first is that you can truly diversify into different types of assets. You're not limited to brokerage assets, stocks, bonds, mutual funds, but you can include real estate, mortgages and notes. You can actually purchase mortgages, and you can lend money from your retirement account. You could also invest in a private business. You choose, you control the investments and the transactions in a self-directed account. You can use leverage to purchase real estate, and I am going to be talking more about that on a future slide, but you can actually increase the buying power of the monies you have in your retirement account by leveraging those funds. And because of all of these things, you may be able to experience a higher return on your retirement investments. Now, there are guidelines that must be followed with all retirement accounts, including self-directed accounts, and that is that there are administrative requirements that must be fulfilled. An annual valuation of your retirement account must be done each year. An annual report sent to the IRS of that valuation, it's Form 5498. Books and records of all of the details of the transactions, purchases, sales, earnings, expenses, all of those must be maintained in detail for your account. Depending on what you own and in what state you own it, state filings might be necessary. And in some cases, tax returns might be required. Those are going to be very specifically related to certain types of transactions. Don't happen very often, but can happen. So I will be mentioning that as well. I will mention right here that STC is a full service self-directed administrator. So that means we will fulfill all of these administrative requirements for your account. With one exception, we are not permitted to prepare a tax return if that does come into play in your account. But what we will do is we will provide you or your tax preparer all the necessary documentation so that you will be able to prepare that. But all of the other administrative requirements we will fulfill for you. Now, some additional guidelines in self-directing are that there, again, with all retirement accounts, is that there are some assets that you may not invest in. They are prohibited assets. And one of those is life insurance contracts. And the second are collectibles. So this are things like rugs, works of art, stamp collections, coin collections. Now, this does not include precious metals. There are certain precious metals that can be invested in a retirement account. That is specifically laid out by the IRS rules. If you're interested in that, I do have a document that I can send you, particularly about precious metals. But coin collections, you may not own those in a retirement account. Other than these two types of investments, pretty much anything else is open, as long as it doesn't violate one of the prohibited transaction rules. So keep in mind that when you are engaging in a transaction in your retirement account, it does need to be for the exclusive benefit of the account. So you can't participate in a transaction that's enabling you personally to do something and won't benefit your retirement account. There does need to be the possibility that your retirement account is going to make money on the transaction. You also cannot borrow money from your retirement account. You cannot personally borrow money from the account. You cannot pledge your retirement account assets to secure a personal loan. Now, I have seen loan papers that you list your retirement account asset, and that's not a problem. It just cannot be collateral for the loan. It can't secure the loan. You cannot utilize your personal credit or guarantee to obtain a loan for your retirement account. And this is important, especially if you're a real estate investor and you're considering using leverage to purchase a real estate property in your retirement account. You cannot personally guarantee that loan. In fact, it must be a non-recourse loan, which again, I'm going to talk about a little bit more on and go into pretty much detail on that. In addition to these prohibitions, you also cannot benefit any disqualified person. So I want to talk a little bit about who disqualified persons are, because again, you can do some very interesting, complex transactions, but you want to be careful about the parties involved, and you want to be sure that you are staying within the rules. The first, you'll see I brought out onto your screen, disqualified person is you. You and your retirement account are two separate entities. Your retirement account cannot do a direct transaction with you personally. And let me give you an example. Let's say you personally own a house that you rent. Your retirement account cannot purchase that house from you. That would violate this rule, and it would be a prohibited transaction. If you are married, this would include your spouse. If your spouse owned that rental property, your retirement account could not purchase it from your spouse. There are additional family members who are also disqualified. Ascendants, so that would be your parents, your grandparents, your great-grandparents on up the line are all disqualified persons to your retirement account. Your descendants are also disqualified. That would be your children, your grandchildren, your great-grandchildren, all disqualified parties. However, lateral family members are not disqualified. So that would include siblings, brothers and sisters, aunts and uncles, nieces and nephews, cousins. None of those parties are disqualified to your retirement account. So let's go back to that rental property. Let's say your mother owned it. Your retirement account could not purchase it from her. Let's say your son owns it. Your retirement account could not purchase it from him. Let's say your brother owns it. Your retirement account could purchase it from your brother. So this is something to just be aware of when you are thinking about transactions and who the parties to those transactions are going to be. Additionally, there are two entities that are disqualified persons, and they are companies or entities. Any company, if you are a majority shareholder. So I'm going to stop here because I often have listeners who perhaps are running maybe a real estate investing business through a company, and that business, they're a majority shareholder. Maybe they own, they're in partnership with other partners, say 3 people, they own 34%, they're a majority shareholder. If a property is owned by that company and you're a majority shareholder, your retirement account cannot purchase it from that company or sell it to that company. In addition, if you are an officer, a director, or a highly compensated employee of a company, that company is a disqualified person to your retirement account. So just some things to keep in mind here. We at STC do not expect you to be an expert in all these rules. That really is our function. I'm giving you this information just to give you some general awareness of, structuring transactions. Our client services department is always available to our clients to talk with them in depth about parties to a transaction, what is permissible, what would violate the rules. So you don't have to be experts. This is really just to kind of give you some general information. Let me tell you a bit more about STC and our full service approach. We do set up a retirement account structure that includes an LLC. And we do this for several reasons, which I will enumerate on the next slide. But we do that setup as part of our service. We also have CPAs and attorneys available to answer your technical questions. Our client services department is very knowledgeable and has great expertise. And if you have a very sticky or unusual question, we do have access to our CPAs and attorneys who can help with those. We offer you unlimited guidance on transaction compliance. You can call our office, email our office, fax our office. Our client services are always available to talk with you and assist you. And, if you have trusted advisors who you want to bring into the loop to talk through a complex transaction, we will talk with you and them as well. So we offer unlimited transaction compliance guidance. We also handle all that back office support, all that administrative function, all the reporting and keeping the books and records so that you don't have to spend your time doing that. We will maintain financial statements for the LLC that we create for your retirement account. This LLC becomes the investing vehicle that you will use to purchase assets for your retirement account, and we will maintain financial statements for that LLC. We will supervise the regulatory reporting that is required, and we will oversee the annual valuation of your retirement account. So really we offer full services so you can focus your attention on finding the best investments for your retirement account, leave all of these other functions to us. Now, I do want to talk a little bit about the LLC structure that we use because it does give you some very enhanced benefits over just a traditional account numbered account. It does give you a great deal of flexibility. Many people come to us with multiple party transactions using leverage, differing percentages of ownership, and perhaps one of the parties is going to offer some particular services in this investment. Using an LLC structure, you can accomplish that kind of transaction. So it does give you a lot of flexibility. It does provide an additional layer of asset protection because it is a true limited liability company, but I will mention also that it is a very specialized LLC. It's not a generic business LLC, but it's an LLC whose articles of organization and its incorporation documents are written so that they comply with the rules related to retirement accounts. So it's got very specific wording. Our attorneys have written these LLC documents to be owned by a retirement account. This LLC also offers you checkbook control over your retirement account funds, which means you have a quick response time to an investment opportunity. Now, you will notice on my slide that I have checkbook control in quotes, and that is because we do not give the checkbook to our client. And we do that really for our clients' protection. We have had some folks come to us who unknowingly engaged in prohibited transactions because they had the checkbook. They wrote a check, they purchased something, and it was not permitted. So having a checkbook, if you aren't an expert in the rules, it can put you in a precarious position. And the IRS is looking at self-directed retirement accounts and looking over transactions, and they have become aware that more people are interested in these and moving money to these kinds of accounts. So it is important that you have somebody reviewing your transactions who is an expert and who can give you guidance on if something is prohibited or not, or guidance on how a transaction can be structured properly so it doesn't violate the rules. So we do that. You send your documents to our client services department. They immediately review them. And if we have all the documents and everything lines up and it's all in order, if we have that by 2 p.m. Eastern time, we can same day fund that transaction for you. And if it's after 2 p.m., then it'll be next business day. So you have a very quick approval and funding for your investment, but you have the protection of experts looking over that transaction for you. Using the LLC also simplifies asset titling. So when you go to purchase something, let's say it is a piece of property, that property will be titled in the LLC's name rather than IRA account number 12345 for the benefit of James Smith. That won't be what's on the title of the property. It will be My Future Investments LLC. So it does simplify asset titling for your investments and, of course, transfer of title. And it does ease pooling or partnering with other funding sources. So I want to mention here, and I will go into some more detail on a future slide, that you do not have to fully fund an investment from your retirement account. You can partner with other funding sources and be a co-owner of an investment. So using our LLC structure makes that a very straightforward process. We'll talk a little bit more about that. Let's talk now about choosing an investment. There are a wide range of investments open to you with a self-directed retirement account. And the first group that I'm bringing out onto your screen are all different types of real estate investments. You can invest in single or multifamily homes. You can invest in vacation property, and I'm going to label that investment vacation property, because I do want to mention that if you do buy vacation property in your retirement account, you cannot personally use it, nor can your parents, nor your children, because that would violate that disqualified person rule. So it does need to be investment property. You could send your sister or your brother there, but you can't use it yourself. You can invest in raw land, in building lots, commercial buildings, real estate syndications where a group of investors get together and pool funds to make an investment. You can invest in tax liens. All of those are different types of real estate investments. And of course, short sales, foreclosures, all of those are possible. You can also invest in mortgages. You can make loans from your retirement account. You can invest in private business investments, operating businesses, precious metals, the foreign currency market, the Forex market, options, futures, and of course, you could have a piece in traditional types of investments like stocks, bonds, and mutual funds. So you really can diversify your retirement holdings with a wide range of different types of assets. Now, I want to just show you the simple process of how investing in an asset with an STC account works. It's a very straightforward process. You are not required to do this first step, but I highly recommend it. You talk with client services department and have them review the transaction and the structure of that transaction in advance. You can call them, talk to them, send them documents. They'll ask questions, make sure that it's a viable transaction that's not prohibited and that doesn't involve any disqualified parties. I highly recommend doing that. It's not required, but it doesn't cost anything extra, so you might as well involve the experts right up front. Then you complete a form. It's called a request to transfer funds form, and you complete that form along with backup documentation for that form, and you can either scan and email that to our client services department, or you can fax it to them, and they will review that transaction immediately. We are getting those in all day long, and that's their total focus, getting those transactions and reviewing them immediately. If there are any questions about the transaction, they will get in touch with you immediately and talk with you about it. And once those have been answered and resolved, if there were any, then they'll process that reform. And that means that they will take funds from the LLC bank account that's related to your retirement account, and they'll transfer those funds to the seller, and then the ownership of that asset will move to your retirement account. So you send the transfer form with the backup documentation, and then client services takes it from there. And again, we have same day or 24-hour next business day processing for your transactions. Now let's talk specifically about purchasing real estate. Now we can't offer you any property. We don't locate property. You will need to find the property that you're interested in investing in and make an offer on that. Now this offer that you make, and I will mention, we also are not permitted to provide any recommendations about whether it's a good investment, no rental advice or resale guidance. We are not permitted to do that as an administrator. The offer that you make on this property must be in the name of the buyer. And so if it's your retirement account with STC, that would be in the name of the IRA LLC that we have set up for you. That if that's the only buyer, then that's the only name that goes on the offer. Now, as I mentioned, you don't have to wholly fund a transaction from your retirement account. So let's just say, I have an example here. You have $50,000 of personal money you could invest, and you have $50,000 in your retirement account. Those two pots of money could co-invest at the inception of a transaction and purchase a property. In that case, both your name and your IRA LLC name would be on the offer documents. And your percentage ownership doesn't have to be 50-50, it can be 30-70, 40-60, whatever. So you can do that, but the offer does need to be in the name of who is going to be the buyer. Now, you will likely need an escrow deposit. And if you do, then what we need is a copy of the contract showing the name of your IRA LLC as the buyer, and then a completed request to transfer funds form, that form I talked about. And if you are going to closing, then we will need a copy of the estimated HUD statement or the settlement statement that shows the IRA LLC as the buyer, and a completed, again, signed request to transfer funds form. And we do request that we get that at least one business day before you're going to closing, by 2 p.m. And sooner than that would be even better. That's really the latest. We would like to have additional time just in case there's an issue, because if the buyer's name is incorrect, we cannot wire funds out. So we do want to make sure that we've seen those documents in plenty of time, that if they need to be changed, they can. And I'll give you an instance of when that has come into play. Sometimes a down payment could have been made that didn't come from the retirement account. If the retirement account, let's go back to the example that the retirement account is going to fully fund this investment. Then if a deposit is required, that deposit must come from the retirement account. You can't personally pay that deposit and then have your retirement account be the buyer. So that would be a problem, and we would need to get that straightened out before we could fund that investment. So just an example, you want to kind of get your ducks in a row, and client services loves to talk with you, so please do use them as much as you need to make sure that your documents are all titled properly and such. Now, Client services discusses the transaction. Now, guaranteed funds, typically the disbursement of the funds for the purchase need to be guaranteed funds. So our clients usually request that we issue a wire transfer. We can do that. You can also do a bank official check. So we have a couple of options on how we can get the guaranteed funds. And then you can go to closing on behalf of your IRA and sign all of the closing documents. One of the benefits of the IRA LLC is that the IRA holder goes to the settlement table and signs all the closing documents. You know, we'll discuss the transaction with you to make sure that you're not dealing with those any disqualified parties or using prohibited funds, and the proper name is titling, but we don't need to approve and sign the documents. And that is required by many custodians when an LLC structure is not used. So just know that that makes it easier for you. It expedites the closing for you. You can go to the closing table. And what we would ask you to do is to send us a copy of the closing document, and then you keep the originals. So we will have documents of what you have closed on behalf of your IRA LLC. Now, you do have the option to use borrowed funds to purchase a real estate property in a retirement account. It must be a non-recourse loan. I am going to, I think I have a complete slide on non-recourse loans, so we'll go over that in detail. When you do use borrowed funds, a potential tax comes into play. UBIT, unrelated business income tax, has a subset called unrelated debt financed income, UDFI, and that comes into play if you leverage a real estate purchase. I'm going to go through an example and talk with you in detail about that on another slide. But just keep in mind that you can use leverage. You do not have to fully fund the purchase from your retirement account. In addition, you can partner with other funding sources. In fact, you can partner with anyone, including disqualified persons, at the inception of the transaction. Now, I want to spend a little bit of time talking about this. Remember, I said that your ascendants are your father, your mother, your grandparents, your children, you personally, your spouse. We're all disqualified persons, and your retirement account could not do a direct transaction with them. And that is true. It cannot. However, if you partner with them to co-own an asset at the inception of the transaction, that is permitted because you're not doing a direct transaction with each other. Rather, each of you is doing a transaction with the seller. So at the inception of a transaction, you can partner with anyone, including otherwise disqualified persons. If some of those you are partnering with are disqualified persons, then the percentage ownership of this transaction, this investment, can never change. That's very important. If they did change, that would mean the IRA and the individual would be doing business with each other, and that is not permitted. So those percentages can never change. All the income and all the expenses of this property are paid pro rata based on ownership. So let's say you personally and your retirement account are going to co-own a property. You're going to put 30% in, and your retirement account is going to put 70% in. You partner at the inception of the transaction, so it's not a disqualified, prohibited transaction. 30-70. That means all of the expenses relating to the ownership of this piece of real estate must be paid 30% by you personally and 70% by your retirement account. All the income that's earned on this real estate asset will come 30% to you personally and 70% will go to your retirement account. So those must stay the same. The expenses and the income are born in the relationship of We do have some clients who want to set up a sub LLC to own a particular piece of property, and you certainly can do that. All of the rules relating to the retirement account still must be followed, even if you've got a sub LLC. So in that scenario, we at STC would want to see an operating agreement that states clearly who the owners of this sub LLC are, the amount they're contributing, and their percentage of ownership. And we will expect the percentages of ownership are going to match up with the amounts that are invested. And actually, this is a requirement if the owners of that sub LLC are disqualified persons. So if you and your retirement account were owners of that sub LLC, then those percentages of ownership would have to match up with how much money was invested. If there are no disqualified parties involved, there is the possibility that one of the parties, if they're serving another role, say a general contractor, and they're not disqualified party, they could get a larger percentage of the profits for that role. So there are some interesting ways that you can structure a transaction, have multiple parties who might be providing contracting services on say a rehab, and all of that can be set up in your self-directed retirement account. So lots of very interesting transactions you can implement. Now, a couple of things to keep in mind, even with that sub LLC, the same guidelines of IRS ERISA rules all apply. So the IRA holder or a disqualified party can't guarantee any loans. So just keep in mind, still all has to follow all the rules. And disqualified persons cannot, in any case, do rehab or repairs on that property, and they cannot be a tenant, a buyer, or a seller of that property. So you personally cannot do rehab work on a property that your retirement account owns. That is a prohibited transaction. So you want to keep those things in mind. Now, I am going to mention here, because I often have real estate investors and sometimes realtors, licensed real estate agents listening to this. I do want to say that we encourage, if you are a real estate agent, we encourage you not to be involved with any transaction that involves your retirement account. It's a very sticky wicket if you do. If you insist on doing it, you cannot receive any compensation from that transaction. And the only way to, for you to be compensated would be for a reduction in the cost to the IRA. So if you have any interest in doing that, we would please ask you to contact client services before you become personally involved in a real estate transaction that involves your IRA, and let us talk to you about it. This is, something that the IRS looks at. So you want to be real cautious in a case like that. Okay, partnering with others. I mentioned this earlier. I'm looking at my time is getting away from me, so I am going to move along here. You can partner with yourself, your spouse, family members, again, as long as it's at the inception of the transaction. You can also partner with colleagues, other LLCs, and investment syndications. So you do not need to wholly fund the transaction yourself. This is a schematic that is showing how our structure works in the setup. Money moves in the upper left from your current custodian to our self-directed custodian. We set up the LLC retirement plan. You see that in the middle. Money moves to an account that your LLC has access to. In this example, you've made 3 investments. Investment 1 is a tax lien investment. Investment 2, you purchase property for rehab and rental. Investment 3, you pooled funds with others to purchase a small retail center. And here you see it happens to be your father, your daughter, and some of your personal money. Again, otherwise disqualified persons, but you co-invested at the inception of the purchase transaction. So that is permissible. Now, I said that I would mention non-recourse loans, and I do want to give you some information about these because I got some preliminary questions before the webinar even started about non-recourse loans. So let's talk a little bit about them. First, what is a non-recourse loan? It means that the security instruments, the notes, the mortgages, they allow no recourse against you individually, the individual account holder, or the balance in your retirement account. The only recourse the lender has is to the actual property that the loan is on. So there's no other recourse. This is somewhat similar to a commercial loan. There's not going to be any income or employment verification because your retirement account doesn't have a job, and there's no personal guarantee here. These are some general industry standards, but of course you would want to go out and look and discuss with some lenders who lend to self-directed retirement accounts and ask them about their terms and the specifics of their loans. Generally required documentation is going to be, of course, a loan application, a purchase and sale contract. They're going to want to see your IRA statement. They'll want an appraisal of the property, and if it's a rental, they'll want a rent roll. Loan guidelines, generally the maximum loan to value you will get is 70%, so that's going to require a 30% down payment. Maximum term can be 20 to 30 years. We do see some lenders who give 3-1, 5-1, 7-1 ARMs, adjustable rate mortgages. They're going to be looking for an income to expense ratio of 1.25 usually. And they are generally going to require that you hold reserves in the account, often 3 to 6 months reserves held in your retirement account. And that is so that your retirement account can pay any unexpected costs or expected or unexpected costs that come up. You need to have those monies coming from the retirement account, so they will want to see that you have some reserves there. Eligible properties for non-recourse loans: single-family residences, some condos, 2 to 4 plexes, multifamily, 5+ units, retail, office, warehouse. All of those are generally eligible for non-recourse loans. Things that are generally ineligible: mobile homes, timeshares, condo, hotels, certain restaurants, residences with large acreage, 5 or more acres, and farms. Those are usually ineligible for non-recourse loans. So just a little bit of information there. Let's talk about UBIT, because if you are using a loan, UBIT will come into play in the form of unrelated debt financed income. What the IRS has deemed is that use of leverage is giving you the opportunity to use money, other people's money, and you're earning income on that, so that should be taxed. So it is a subset of UBIT, and it applies to any income that is generated from an asset that's purchased using financing. Now, it's based on the net income of the property, so not the revenue that's generated, but the net income. So revenues less expenses, and the first $1,000 of net income is exempt from the tax. Now, the percentage of taxable income is based on the ratio of debt on the property. So if the property is 50% debt financed, then only 50% of the net income is subject to the tax. If the property is 100%, well, it couldn't be 100%, 70% debt financed, then only 70% of the net income is subject to the tax. When the time comes to sell the asset, if there has been any outstanding debt in the prior 12 months, the point of sale, then there will be tax on the sale. And at that time, the gain is also subject to UDFI. And that time, the calculation will be the debt to the sales price. So if you need more information about how that would be calculated, of course, you can talk with your tax accountants, and they should be able to assist you. But let me give you an example. Those are all the nuts and bolts, but let me show how it might work in an example. Let's say that you purchase a rental property that's 50% debt financed. Your annual rental income is $12,000, $1,000 a month. The income that's subject, and you notice I said net rental income, so expenses are already taken out of that. The income subject to UDFI is going to be $5,000. You earned $12,000, only 50% of it is debt finance, so that's 50% of 12 is $6,000. The first $1,000 is tax exempt, so $6,000 minus $1,000, $5,000 is what is subject to UDFI. Now, it is taxed at the trust tax rate. I picked, the last time I looked at this, I picked the high end of the trust tax rate. This might be changing if our tax code changes, but right now that was 39% the last time I checked. So we'll just use that number as the high end. That would mean your taxes on this particular transaction would be $1,950. So your net income after taxes would be that $12,000 up above less $1,950 or $10,050. Now, so when you're evaluating whether or not it's to your benefit to use leverage, even though it will involve some taxes, you want to look at that bottom line and you want to say, okay, well, I'm okay with paying $1,950 if I'm going to earn $10,050 in my retirement account. So I've heard in talking with some folks, you know, they go, oh, no, I don't want to pay taxes. But really, you want to do the calculation and see it might give you enough income that it's worth it to pay the taxes in order to be able to fund that transaction. Now, UDFI is reported on IRS Form 990T at the taxable trust rate, and we do recommend that you discuss with your tax advisor. So now it's time for Q&A. I'll put this information up while I open up my question box and look to see who has asked me some questions. So please hang on just a moment. Okay. Thank you so much, everyone. I did have some questions that came in before the webinar as well. Okay, I would like to learn the best retirement account vehicle for lending money to real estate investors. Well, first, you will need a self-directed account. So I think it's highly unlikely you would be able to lend to real estate investors from a traditional type of IRA. So you'll need a self-directed account. What type of account? Traditional, Roth, SEP, simple, whichever one of those you qualify for. If you have earned income and you could set up a traditional IRA, a Roth IRA does have some annual earnings limitations, but you can get around those by making a contribution to a traditional and converting those contributions to a Roth. So you could get monies into a Roth account. A SEP, if you have a business, you could move money into a SEP account. If you're in a partnership, maybe you want to look at a simple plan. So any of those plans with a self-directed administrator would permit you to lend money to real estate investors. Okay, someone has asked our fee structure. What I'm going to do is actually send you our client fee schedule, but I will tell you initially that we currently have a setup rate of $1,000 to create your LLC, your IRA LLC. That is a current discounted rate that is a limited time. So if you are interested in that discounted rate, please do get in touch with me as soon as possible. And then we have an ongoing management fee, which is 0.245% per quarter. So it's less than 1% a year. We do cap our fees. Once your account value is around $400,000, your fees are capped. And we have a minimum fee of $74 a quarter. So I will send you the client fee schedule if you are interested in that. Okay, another question. When purchasing real estate, at what point am I subject to UBIT and need to file a tax form? Do you file the form? I probably answered this in the body of the webinar, but I'll answer it again. First, it's only when you purchase real estate using leverage. In other words, you got a loan. If you outright purchase the real estate, UDFI does not come into play. That's only if you use leverage. When do you need to file a tax form? Based on the calendar year that your retirement account earned income. So if it earned income, if it had a net income, so after expenses, had a net income in a calendar year, then for that calendar year, it would be required to pay UDFI based on that first $1,000 pro rata net income, first $1,000 exempt, and that tax rate. So you would talk with your tax accountant about that. And no, we are not permitted to file that form for you because we are not licensed tax accountants, but we will give you all the documentation that you or your tax preparer need. Okay, another question. Can I get a mortgage on a property for my IRA? Yes, this is the same. It'd be a non-recourse. You know, and you can also borrow from others too. You know, it doesn't have to be a commercial lender either. Okay, this question is about a required minimum distribution. So a required minimum distribution, RMD, is required in some accounts, a traditional, a SEP, other types of qualified plans, when you reach age 70 and a half. Law requires you to take at least a minimum distribution from your account. And the question is the RMD based on total assets or cash in hand or equity? So I'm going to answer this generally, and again, you can talk with your tax accountant. Generally, the required minimum distribution is calculated for each account by dividing the prior December 31st balance of that account or retirement account by a life expectancy factor. If you own real estate, then the fair market value of that property is included in the balance of the account. So it's the fair market value of the property plus other assets plus cash. So that comprises the balance of your account, and that is what your RMD would be calculated on. Can you make a maximum contribution to both a regular and a Roth IRA in the same year? No, the answer is no. You are limited to either a maximum of $5,500 or $6,500, depending if you're 50 or older, of your earned income. Now, you can divide it between two different types of account. If you have both a traditional and a Roth, you could put $2,500 in your traditional and $3,000 in your Roth, but you are limited by that cap in total. Can my retirement account purchase additional interest in a property I'm already invested in? I'm sorry, the answer to that is no. Because you already own it, your retirement account can't do a direct transaction with you, and that's what that would be. So not if you already own it. Now you can go in together to purchase a new property. Okay, let's see. Are there special accounting or bookkeeping needs for running a rental property owned by an IRA? Nothing special, except that all of the transactions need to be accounted for within the retirement account. So with STC, bills are paid through STC for your retirement account, and so they would be recorded in your account as expenditures. Rental incomes will come to STC for your retirement account, and they'll be recorded as income into your retirement account. So we will keep all of those transactions accounted for in your books. You don't have to do that. That is part of the service that we offer. Can I sell a portion of a property owned by my IRA to a non-disqualified person? Yes, if they're not disqualified, when you say you, it's actually your retirement account that would be selling it. And so the property would be retitled as a co-owner now with this non-disqualified person in the percentage ownership based on the money they pay you for that. And you would want to discuss that kind of a transaction with client services, because that would involve some work in appraising and retitling, and so you'd want to talk to client services about how to exactly go about that. Let's see. I'm about to run out of time, so I think I've just got one more new question here. Can I set up a regular business, for example, a C Corp, owned 100% by the IRA that buys and sells items? I think I'm not an incorporation expert, but I believe a C Corp does not permit a retirement account owner. I believe that's right. I will need to do a little bit of more research on that for you. And so I see who's asked that question. I believe, though, that is the answer, but I will confirm that for you. Can one keep a checkbook for a rental property rather than having all transactions go through STC individually? To my knowledge, we do not permit that. We have the monies run through us. Now, we are very responsive, and we can get those monies paid. We do this for many clients. So we have many clients who do this exact thing, have rental properties or are rehabbing properties and have monies needing to go through their account. Okay, I think I'm over my time. Folks, I'm sorry. If you have additional questions, you see my email address on your screen and my that's my direct cell phone. So please do email me or call me. I so appreciate your participation and all of your questions. And I hope that you will join us for next month's webinar, which is entirely Q&A. So I will do just a little bit of explanation about self-direction, and then the majority of the content for the webinar will be Q&A. So you can also send me lots of questions in the meantime. That will be on December 5th, I believe, the first Tuesday of December. If you've got an invitation to this one, you'll get an invitation to that as well. And you can also always register on our website, and you see that there on your screen. Thank you so much for participating, and let us know how we can be of service to you. Thank you.